So today I'll be reading this paper here that I stopped yesterday. And I think I'm gonna be here for around 2 hours. And so this is probably gonna take me a long time to understand. And I'm probably not gonna get it the first time. So my plan is to just do this on stream where I just read this stuff and try to understand the Uniswap thing. And then off stream I'm gonna study the other exchanges. So I think I'm gonna be limiting my time that I spend here so I can cover all of the other ones. And then once I have all the equations for the other ones, then I can focus more on this, because I think the Uniswap is probably the most difficult one, even though the one that I just saw is also a little bit more complicated than just the exponential equation of x times y equals k. So yeah. And then on top of that, I also have to figure out how to get the information from the smart contracts of all of them, to get the data of the pairs and the reserves. So that's gonna take a long time as well. The extensions of the optimal arbitrage problem. There are several natural extensions to the optimal problem, which retain most of its useful. Good morning, M. Tolly. Useful properties. Risk models. There are many factors which could potentially cause an agent to fail to close an arbitrage opportunity, including noisy information, front-running, and delaying trades, the latter of which is quite common in distributed platforms. In particular, it may not be desirable for an agent to perform a trade with the exact solution of problem 2. In this case, we add an additional term penalizing large trades. In other words, we can assign some cost of risk, which can be any convex function. So I wasn't sure about the convex function because I forgot, but then I researched some videos and it's just a parabola. So pretty much a convex function is any function that the base, if you cross a line between 2 points, is not gonna have anything above those 2 points, if that makes sense. So it's, yeah. I don't think I'm gonna spend time explaining that, but I think I got it now. So this I don't really understand, this syntax, which is non-decreasing in its second argument. This gives a problem of the form maximize delta A, delta B. So if I remember correctly, MP is the market price, delta A is the variation of one of the tokens price, and delta B is the variation of the other one. So you're trying to maximize the differences without changing the price too much, I think. Yeah, so I'm not sure if MP is the market price of the 2 tokens you're trading or the other market price that you're gonna use to arbitrage. So let me go back here. Yeah, MU is the optimal. So this is the formula. And then when it deviates to 0, it means there are no arbitrage because there is no difference in price, I think. No, this is an infinitely small trade. So when the trade is infinitely small, the variation is gonna be equal to this MU here, because it's pretty much making the deviation equal to 0 there. So you can always make a non-zero profit if the Uniswap marginal price of alpha is smaller than the market marginal price. So MP is the market marginal price, which is outside of the trade, I think. My performance is more of trade. So it's finding the infinitely small price by differentiating the constant product formula. Where K equals 0. And then finds this equation, passes the y to the other side, cancels out. And RB divided by RA is MU. Can always make a non-zero profit if the Uniswap marginal price of alpha. So if MU is smaller than the market marginal price. So MU has to be smaller than the market marginal price. Why though? So I think I'm gonna spend time trying to understand this concept. I think market marginal price, MP, is the price outside of the thing. And MU is the price of the difference. And I don't really understand that really well. The Uniswap marginal price. Yeah, so you're buying B, beta, and then it's gonna decrease alpha. But the thing is, why isn't delta alpha and delta B the same thing? Oh no, because the price is different. That's the thing. So yeah, I think that's the biggest problem I've been having so far, that I didn't really clarify yet, which is the difference between the price and the reserve. I don't really understand that really well. What is the price evaluated at? Because if it is in relationship to the reserves, then how is K decided? Like when you're placing your first deposit in the pool, how is the ratio between the two going to be decided? It's going to have to follow the market price outside. Guys, that's the thing that I need to clarify more, I think, first. Because this is probably why I'm not understanding this correctly. And I think what it's saying is the deviation on the reserve A after you make the trade is this side, and the deviation on B is this because of the fee, and that equals K. And they are different because the reserves are different. So I'm gonna go back to this part. So now it's making delta A go towards 0, which means that K is gonna be 0. And what does that mean? It means you're not trading. And then it's saying that the market, the Uniswap market marginal price of alpha is smaller than the market marginal price. So what this is saying, I think, is even if you have a very small trade and the market price is smaller than that, that means that an arbitrage is going to be profitable because at worst you're breaking even. Yeah, that's what's happening here. And you have to multiply by the fee because obviously you're going to pay the fee. Okay, so now I think I got it. Similarly, by swapping alpha for bet, but I think I'm going to search before I move on with this. I'm going to search how is the price calculated. Our relationship between price and reserve Uniswap. Maybe watch a video about this as well. The issue is that it's kind of hard to find the answer to these questions. Both because it's hard to phrase what I wanna understand and because people usually talk about the introductory stuff. What's the relationship between LP reserves and swap rates? Maybe if I search for how is the price of an asset calculated in Uniswap. It's gonna tell me that it's x times y equals k. That's the problem. Each pair on Uniswap is actually underpinned by a liquidity pool, unique tokens, enforced rules, constant product formula. Uniswap your trades are always executed at the best possible price, calculated at execution time. Somewhat confusedly, this calculation is actually accomplished with one of two different formulas, depending on whether the trade specifies an exact input or output amount. Functionally, the difference between the two functions is minuscule, but the very existence of a difference increases conceptual complexity. Initial attempts to support both functions in V2 provide inelegant, and the decision was should not provide any pricing functions in the core. Instead, pairs directly check whether the invariant was satisfied, accounting for fees after every trade. This means that rather than relying on a pricing function to also enforce the invariant, V2 pairs simply and transparently ensure their own safety. A nice separation of concerns. One downstream benefit is that V2 pairs will more naturally support other flavors of trades which may emerge. Trading to a specific price at execution time. High-level Uniswap future trades must be priced in the periphery. Is that library provides a variety of functions designed to make this quite simple, and all swapping functions in the router are designed with this in mind. When swapping tokens on Uniswap, it's common to want to receive as many output tokens as possible for an exact input amount, or to pay a few input tokens as possible for an exact output amount. In order to calculate these amounts, a contract must look up the current reserves of a pair. In order to understand what the current price is, however, it is not safe to perform this lookup and rely on the result without access to an external price. It is not safe to perform this lookup and rely on the results. Say a smart contract naively wants to send 10 DAI to the DAI width pair and receive as much width as it can get given the current reserve ratio. If when called, the naive smart contract simply looks up the current price and executes the trade, it is vulnerable to front-running and will likely suffer an economic loss. You see why I consider a malicious actor who sees this transaction before it is committed. I skip a swap. Okay. So they can make an order before the order increase the price. Low risk. And to prevent these types of attack, it's vital to submit swaps that have access to knowledge about the fair price their swap should execute that. In other words, swap need access to an oracle to be sure that the best execution they can get from Uniswap is close enough to what the oracle considers the true price. While this may sound complicated, the oracle can be as simple as an off-chain observation of the current market price of a pair. Because of arbitrage, it's typically the case that the ratio of the intra-block reserves of a pair is close to the true market price. So if a user submits a trade with this knowledge in mind, they can ensure that the losses due to front-running are tightly bounded. This is how, for example, the Uniswap front-end ensure trade safety. It calculates the optimal input-output amount given observed intra-block prices and uses the router to perform the swap, which guarantees the swap will execute at a rate no less than X percentage worse than the observed intra-block rate, where X is a user-specified slippage tolerance 0.5 by default. So I think I understand better now. So it's pretty much doing both. Is both checking an oracle for the real market, let's say real outside market price, but is using the reserve ratios. So just checks to see if there's slippage, and the slippage is the difference between the two. Now I get it, I think. So that means that if there is no slippage, there is no profit. And the higher the slippage, the higher the profit. If it is this way that I'm thinking about. But then that wouldn't make a lot of sense because... Oh, it actually does make sense. Because... Yeah, but if you're doing the... Yeah, it doesn't make sense. I guess the difference between the prices is bigger than the slippage. Then there is a profit. Yeah, that's how it works. So we have the distance between the market price MP and MU, and that distance is measured by those equations, and the slippage and the fee are a portion of that distance. So you only have profit when the distance is greater than. But yeah, I think the paper is going to talk about slippage further, and it didn't incorporate that yet. So at the beginning of any pool, or the smaller the pool, probably at the beginning actually, then yeah, but then how does it work? It's probably calculated through the oracle, the first ratio. Other options are cognitive features. Exact input. If you'd like to send an exact amount of input tokens in exchange for as many output tokens as possible, you want to use get amounts out. If you'd like to receive, okay. Uniswap V2 includes several improvements for supporting manipulation-resistant public price feeds. First, every pair measures but does not store the market price at the beginning of each block, before any trade takes place. This price is expensive to manipulate because it is set by the last transaction, whether it's a min swap or burn in a previous block. To set the measured price to one that is out of sync with the global market price, an attacker has to make a bad trade at the end of a previous block, typically with no guarantee that they will arbitrage it back in the next block. Attackers will lose money to arbitragers unless they can selfishly mine 2 blocks in a row. This type of attack presents several challenges and has not been observed to date. Unfortunately, this alone is not enough. If significant value settles based on the price resulting from this mechanism, an attack's profit will likely outweigh the loss. Instead, the Uniswap V2 has this end-of-block price to a single cumulative price variable in the core contract, weighted by the amount of this time this price existed. This variable represents the sum of the Uniswap price for every second in the entire history of the contract. Time-lapse is the time between the end of a block and the start of the next. Starting price of a new block is same as ending price of the previous. So I guess this is where the tick thing comes from. P is the market price at a moment in time, not the execution price of a trade. This variable can be used by external contracts to track accurate time-weighted average prices across any time interval. The TWAP is constructed by reading the cumulative price from an ERC20 token pair at the beginning and at the end of the desired interval. The difference in this cumulative price can then be divided by the length of the interval to create a TWAP for that period. But this still doesn't talk about the market price. I think, the question is, what is this block referring to? Is it referring to probably Ethereum? So it's calculating the differences in blocks in Ethereum, I think. Can be used directly on as the basis for moving averages as needed. For a 10-minute TWAP, sample once every 10 minutes. For a 1-week TWAP, sample once every week. For a simple TWAP, the cost of manipulation increases approximately linear with liquidity on Uniswap, as well as approximately linear with the length of time over which you average. The cost of an attack is relatively simple to estimate. Moving the price 5% on 1 hour TWAP is approximately equal to the amount lost to arbitrage in fees for moving the price 5% every block for 1 hour. There are some nuances that are good to be aware of when using Uniswap V2 as an oracle, especially where manipulation resistance is concerned. Elaborates on some of them, additional oracle-focused developer guides. In the meantime, check out the example documentation. Reduce the cost of attack for more in-depth review. It's still not really clear to me, because I don't understand this block thing. If it's tracking I think, it tracks the price of Ethereum. The price is on Ethereum, because Uniswap is only ERC20 token, pairs. So probably all the pairs, the transactions are in the blockchains of Ethereum, and then it uses that to figure out the price. And I guess it does that for all the tokens that it has. And then compares that with the liquidity, with the reserve ratio. Yeah, this is the stuff that I was reading before. Trend stops attack. Because of arbitrage, it's typically the case that the ratio of the intra-block reserves of a pair is close to the true market price. So if a user submits a trade with this knowledge in mind, they can ensure that the losses due to front-running are tightly bounded. This is how, for example, the Uniswap front-end ensure trade safety. Calculates the optimal input-output amount given observed intra-block prices, and uses the router to perform the swap, which guarantees the swap will execute at a rate no less than X percentage worse than the observed intra-block rate. So it calculates the intra-block prices and uses the router to perform the swap. No less than X percentage worse than the observed intra-block rate. So this is just referring to the interest stuff. Where X is a user-specified slippage tolerance. But this doesn't refer to the... So this slippage is just the discrepancy of the actual trade and the pricing intra-block of the only reserves. But how does that relate to the market price? Maybe you should watch a video if someone has made a video about this. I think I already watched this video.
I showed
Watch
you
it
the
again.
math for how to calculate TWAP, time weighted average price. In this video, I'll show you how to actually calculate it in Uniswap v2 using Solidity. Here I've already created a hard hat project and installed some packages. Notice that for this contract, we're using Solidity 0.616. This is because the two Uniswap npm packages that we're going to need is targeted for Solidity 0.616. So that is why we're going to be using the older version of Solidity to write this contract. The first thing that we need to do is import some Solidity contracts from the Uniswap npm library. I'll name this contract Uniswap v2 TWAP. In Uniswap v2, the numbers are represented in decimals, but Solidity does not have any decimal data types, so they created their own called fixed point. So to use decimals in this contract, we'll have to declare using fixed point for start. Next, we'll define the minimum time that we need to wait before we can update the TWAP. I'll call this uint public constant, all caps, period, is equal to 10. This means that we'll have to wait a minimum of 10 seconds before we can update the TWAP. Now, if you're writing a TWAP in the mainnet, this will usually be something like 30 minutes, 1 hour, or more. But for this example, I don't want to wait too long, so I'll just make it 10 seconds. The pair contract is a contract that holds the two tokens and does the swaps. So you'll say I, uni, swap, b2, pair. I'll make this variable public, immutable since it does not have to change, and I'll name it pair. We also store the two tokens by saying address, public, immutable, token 0, and likewise address public, immutable, token 1. To calculate the TWAP, we need to store a variable called price cumulative. So I'll type uint public price 0 cumulative last, and likewise for price 1 cumulative last. And we'll store the timestamp of when these two price cumulatives were last updated by typing uint32 public block timestamp last. Next, we'll store the TWAP for token 0 and token 1. So I'll type fixed point dot uq112 times 112. This variable will be public, and I'll name it price 0 average. And likewise for price 1 average. This data type fixed point dot uq112 times 112 is not a data type that is available in Solidity. It is a data type that is defined by Uniswap v2, and we import it over here. What this data type does is it represents a decimal number. The range for this decimal number is from 0 to 2 to the 112 minus 1, and the resolution is 1 over 2 to the 112. So this data type, the first 112 bits represents the decimal part, and the next 112 bits represents the whole number part. Next, we'll write the constructor and initialize some of these variables. So I'll type constructor. For the input, we need to pass in the address of the pair. So I'll type I uniswap b2 pair. I'll name it underscore pair, and this constructor is public. Notice that since we're using Solidity 0.6, we need to declare the constructor as public. If you're using Solidity 0.8, then you don't have to declare the constructor as public. Then we'll assign the pair from the input to the pair of the state variable, pair. If you're confused by this syntax over here, then this code is the same as passing in an address, and then passing in the address to the interface. The top code over here is shorter, so this is the code that we'll be using. We also set token 0 and token 1 by typing token 0 is equal to pair.token 0, and likewise for token 1. We also record price 0 and price 1 cumulative last, and the last time that these variables were updated, block timestamp last. So I'll type price 0 cumulative last is equal to pair.price 0 cumulative last. Likewise for price 1 cumulative last, get it from pair.price 1 cumulative last. And then we'll update the block timestamp by calling pair.getReserves. Get reserves returns 3 outputs, reserve 0, reserve 1, and block timestamp last. We only need the third output, so we'll ignore the first two output and assign the last output to block timestamp last. And that completes the constructor. For this contract, we'll write two functions. Function called update. This will update the price 0 average and price 1 average, and the function consult. For the input, a user will pass in the token, either token 0 or token 1, and amount in. This will calculate the amount out using either price 0 average or price 1 average. Let's write the function update first. When the function update is called, we'll first get the current price 0 cumulative and price 1 cumulative. So we'll type uint price 0 cumulative, uint price 1 cumulative, and uint32 block timestamp is equal to Uniswap v2 Oracle library dot current cumulative prices, and we'll need to pass in the address of the pair, so we'll say address pair. Notice that since we define the pair as an interface, here we'll need to cast this pair as address. Once we get the current price 0 cumulative and price 1 cumulative, and the last time that this pair contract was updated, which is stored in block timestamp, next we'll calculate how much time has elapsed since the last time we called update and this block timestamp. So we'll say uint time elapsed is equal to block timestamp minus block timestamp last, which is a state variable that we define. We'll require that the time elapsed is greater than the minimum duration before we can call update, and this is stored in period. So here we'll say require time elapsed is greater than or equal to period. With the error message, time elapsed is less than min period. Next, we'll calculate the price averages by taking the current price cumulative, subtracting it from the last price cumulative, and dividing it over the time elapsed. So we'll type price 0 average is equal to price 0 cumulative minus price 0 cumulative last divided by time elapsed. Now, since price 0 average is a fixed point, we'll need to cast this into a fixed point. So we'll type fixed point dot uq112 x112 parentheses. This uq112 x112 is actually a struct, and the input for this struct must be a uint224. So we'll cast this expression as uint224 by typing uint224, wrap this whole expression, and that completes price 0 average. Notice that this expression over here, the current price 0 cumulative minus the previous price 0 cumulative divided by the time elapsed, is the exact same equation that we derived for how to calculate TWAP in the previous video. So we'll do the same thing to calculate price 1 average. So we'll type price 1 average is equal to fixed point uq112 price 1 cumulative minus price 1 cumulative last divided by time elapsed. Notice that for this expression over here, we're subtracting two numbers, but in Solidity 0.6, there is a possibility for overflow and underflow. This is a desired behavior. We do not care if the numbers overflow. Let's say that we have two numbers, the previous price cumulative and the current price cumulative, A and B. When we do a subtraction, we get this distance. For this example, the distance between B and A is 5 of these dashes. Now imagine a case where the current price cumulative overflows, so that the previous price cumulative is greater than the current price cumulative. However, when we subtract B from A, notice that the distance is still preserved. Before we set the distance was 5 of these dashes. Even after the number B overflows, the distance between B and A still remains the same, 5 dashes. So this is why we're not using safe math over here to subtract these two numbers. Once we get the two price averages, we'll finally update these state variables. So I'll scroll down and then type price 0 cumulative last is equal to the current price 0 cumulative. So that'll be price 0 cumulative. And likewise for price 1 cumulative last. And lastly, we'll update block timestamp last is equal to block timestamp from Uniswap. And that completes the function for update. Call this function once, wait for a minimum of period, call it again, and you'll be able to compute the two time-weighted average prices. The first thing that we'll do is require some error. The first error is time elapsed, which I've missed.
So I guess it just checks for the intra price, and it doesn't have anything to do with the market price. We didn't read this part, I think. I think I read this part. I'm just gonna continue to read the stuff. I'll probably revisit this later. Similarly, by swapping alpha for beta and combining the resulting statement, we get the following bounds of the Uniswap market price relative to the true market price. Assuming no arbitrage conditions. So mu is on between the interval of the size of the fee. I think that's what this is saying. This suggests that in practice, the larger the trade fees are, the larger the gap between the true market price and the Uniswap market price may be. For example, in the case that the trade fee is equal to this, is small bound 3 is approximately equivalent to this. While we derived these conditions using a simple argument, we can also easily derive them by analyzing problem 2 and noting that its optimal value is non-zero if and only if there's an arbitrage opportunity. Extensions of the optimal arbitrage problem. There are several natural extensions to the optimal problem, which retains most of its useful properties. Risk models. There are many factors which could potentially cause an agent to fail to close an arbitrage opportunity, including noisy information, front running, and delaying trades, the latter of which is quite common in distributed platforms. In particular, it may not be desirable for an agent to perform a trade with the exact solution of problem 2. In this case, we can add an additional term penalizing large trades, in other words, slippage. We can assign some cost of risk, which can be any convex function, which is non-decreasing in its second argument. This gives a problem of the form. Oh, so now I think I get it. So it's subtracting, this function is the additional, is the additional risk outside of the fee. So you're trying to maximize the alpha, which is the market price times alpha minus the difference in B, which is the cost of the trade because of the ratios. I think I understand now. It should be noted that problem 4 can be written in a convex way and is the problem we use to simulate arbitrageurs in our agent simulation. One example of a risk function f could be a model of the resulting changes in market price due to the arbitrage trade. A common and simple model for the marginal market price after a trade of size, so the trades between these numbers, is that the resulting price is, so 1 minus the difference. This part is the one that doesn't make sense to me because they included some variables, but I guess this is, maybe it is a common number. Oh, it's a gradient? What does that mean? Is because as far as I know, the gradient is the derivatives of something. Maybe you're talking about this. This I know that it is the difference between the alpha, the reserves of alpha, but I'm talking about this letter here. I think it's epsilon that it says. I'm not sure. The delta. But do you know what this epsilon is? Because it seems like they put here, it might be a mathematical constant or something like that I just don't understand. So it's saying that the trade goes from 0 until this number, and I don't know what this number is. And the resulting price is going to be the market price times 1 minus the difference. 1 minus n times the delta, which I also don't understand how this is achieved as well. So I get that it is between, usually means the marginal of error that you should accept. Oh, okay. Yeah, thank you. Yep. But the thing is, well, maybe it's talking about percentages, right? Because the difference in the ratio can be bigger than 1. As far as I understand. Like it can be any number depending on the order size. Difference in their reserves. And then the resulting price is going to be the market price times the percentage, probably. The percentage of the movement from the initial reserve to the final one. Which is gonna be less than it was before because you made the trade. I think that's what this is saying, but I'm still not sure about the number here and why is multiplying this other n here with any n bigger than 0 and epsilon. I'm gonna say epsilon, I'm not sure if that's how I say it. But the resulting risk function f is the integer from 0 to the distance from microprice minus mt in dt, which I assume is time. So from the time, the distance from 0 and the delta based on the time of the trade, I think, minus the market price, is convex. So this is a convex function, okay? See appendix A.1 for more details and extensions. Additionally, in this model, unlike in problem 4, an arbitrager is not guaranteed to reach the no arbitrage condition in a single round if the penalty function does not reflect the true underlying market movement. So it's not guaranteed to reach the no arbitrage condition in a single round if the penalty function does not reflect the true underlying market movement. So I think pretty much what they're saying is that if the equation doesn't take into consideration the actual movement, it means that there's still money left. That's probably what this means. Because you can't predict with certainty all the variables of front running and all the other stuff. In this section, we show a few basic and useful properties which Uniswap and other constant product markets satisfy. Increasing product constant. For every trade, the product constant K is non-decreasing and strictly increasing if whatever is Y is smaller than 1. Let this be greater than 0, be the reserve of alpha, beta, and the constant product at trade T. If trade T plus 1 sells delta beta coins B for delta alpha coins A, we have by definition this function. So you're selling, so you're pretty much buying A from B, and it's gonna be the difference times the fee. That should be smaller than this at a different time, I think. So they're pretty much the same equation, but without the phi here. Y equals gamma. Okay, thank you. I need to study more mathematics again because I forgot a lot of stuff. And it's probably a good idea as well to, at some point, pick up pen and paper to try to understand it better. I think so far I'm following the thing though. So this means here, I think that the difference after the trade has to be greater than before. I'm not sure. One strictly accept it when gamma equals 1. So if gamma is less than 1, we have that k smaller, kt is smaller than kt plus 1, always. Yeah, because of the phi. So obviously if the phi is smaller than when you don't have the phi, it's going to be greater, but so it is what I'm thinking about. Because they are comparing the difference of movement after the trade and before the trade. And then they're saying that after the trade, the difference has to be bigger. I think I understand. Because you're having the in price on the thing. I just want to make sure I spend more time because it's kind of hard to understand, to be honest. Like, I think I get it, but I really want to get it, you know? I think k on time t should be less than... So k on time t should be less than or equal to the next step, k on time t plus 1. Yeah, exactly. But why though? Because before the thing, you have the phi, right? So it's the difference counting with the phi. And then after, you don't have the phi. So it's pretty much measuring the impact of the phi on the thing. R elevated to t plus 1. Yeah, exactly. So instead of RT here, right? Because it's a different reserve. That's probably why it is a little bit confusing. But then why does this doesn't have the phi? Is because that they are considering that you already made the trade, so the phi doesn't take into account. So the distance is gonna be... So the distance has to be even greater than the phi, that's what they're saying. Gamma? What do you mean? I think what they mean is that the distance has to be greater than the phi. That's what it means. Gamma is on the left side, but not on the right. Yeah. Because gamma is the phi, and then if this is smaller than this, it means that you're paying just for the phi. But if it's bigger, then it means that you made profits because you're surpassing the fee. But this has to be in relationship to the other market. That's why it's confusing, because we don't have here the market price to compare these two. And then this part as well, I have to understand, where inequality always holds strictly except when gamma equals 1. So when gamma equals 1, then obviously it's gonna be the same formula. So it means that it has no fees. Yeah, because gamma is probably in percentages, I think. Yeah, it has to be in percentages because delta B is the difference in the reserve B. Thanks for the follow. It's probably pseudo base. Since you're the one writing the chat. So if it's smaller, we have that K is smaller always. Yeah, the only thing here that I'm not 100% sure is that omega is in percentages. Because, so if it's smaller than 1, then obviously the left side is smaller. And if it's bigger, then it's bigger. But I'm not exactly sure. Maybe omega isn't the fee here because then if that was the case, then if the fee is smaller, then you always have a profitable opportunity, which doesn't make sense. So I think omega is probably a different thing. Maybe omega takes into account the risk as well. Swing trades is more expensive whenever omega is smaller than 1. Any agent trading some amount for some output and immediately trading another amount for delta B will always have smaller output than if the agent had traded for some output total all at once. Obviously because they are paying the fee twice. This property is also sometimes called path dependence. So this is another thing that I was thinking about the other day, which is probably there's definitely a correlation between the amounts of legs in the arbitrage and this effect of the fee. So there's probably a formula that calculates the, maybe they will talk about this later as well. How long can you go before? I guess that's the interesting part and probably the challenging part that I have to do doing this, which is calculate the function that takes this connection, which is the more the compounding effect of the fee, the higher the difference has to be. And there's always this balance effect. And timing obviously also has to be taken into account because the price is always moving. This can easily be proven, though it is mostly an exercise in algebra. We outline the steps in Appendix D. The thing that I don't like about this kind of papers is that they seem to make things more complicated. I don't know if I'm just projecting, but sometimes I feel like they write things in a certain way just to sound smarter. But if you break it down, it's actually simpler. On page 21, the choice of omega that gives the growth rate is the no arbitrage fee. Okay, let me see if I understand what you're saying. Given two sequentially feasible trades, and we will show that the aggregate trade total B always satisfies bigger than the difference for any fee with. Yeah, that's what I'm saying. Like, yeah, but if you think about it, even in non-mathematics, just the concepts, it makes perfect sense. Because if you take more than one trade, you pay more fee. So it obviously means that it's always better to pay only the fee only once. Copy and paste the tax is between 0 and 1 for gamma. So gamma has to be the percentage, right? The percentage of the fee. Oh, interesting. I think I'm gonna go linearly because, like I said before, I'm probably gonna spend a lot of time understanding this. So I'm gonna read once linearly, then I will think about the stuff that I still don't understand, probably research online, and then come back to this and do this over and over until I can translate this into code format, which is probably gonna be the hardest part actually. And then I don't know how long that's gonna take, but I think I stopped here. I don't remember reading this. Maybe. Oh, here. Appendix says everything, by the way, for the selection of values of for the parameters. Oh, really? So it's up where? At the bottom here? No, I have references. Do you know which page? Maybe I don't have on this one. Conclusions. Yeah, I don't see the appendix here. Yeah, but where is it? I think I'm missing the appendix because I just downloaded the page. I can't find it here. Do you know the link or something like that? That would be great, actually. But like you said, so then it's probably a value from 0 and 1. And when it's 1, then it's equal. So there is no difference. Which means that the price didn't fluctuate. And then when gamma is smaller, then it means that the difference fluctuates over time. Every page, after page 15, okay. Thank you. Also in the conclusion here. Oh, this is probably in the references as well. Oh, I see. These ones are probably the explanation of the previous ones. Oh, I get it now. That's so dumb. It's good though, because then you force yourself to understand it. So I think I was on this part. And this is the stuff that you were saying about the gamma. Am I reading this paper? There's two reasons. The more short-term one is because I'm gonna build something through arbitrage for multiple dexes. I don't think it's possible. Maybe it is possible, but I don't expect to make a lot of money. If I do make money, it's gonna be probably in the dollars, not anything substantial. But the reason why I'm doing this is so I can learn more about everything, solidity, the way that the blockchains work, the whole ecosystem, and then further, eventually, well, I can also build something out of this for, which I think I am going to do, which is build machine learning models based on this data and make analysis on that, which is also going to be a training practice for other goals that I have. And then eventually I also wanted to increase my understanding of how market economies work by using the data and by putting all these formulas. And then eventually the more data I get, the more I'm going to be able to run complex machine learning analysis on all of this. And then I'm going to have a clear picture of what's going on. And then on top of that, you can probably put some physics concepts and then start expanding from that to build more things. But obviously, I'm not sure if I'm going to do all this stuff because it's extremely hard. And I also have to make money. So I'm probably going to have to find a job eventually later this year. And if I don't do that, I'm probably going to try to do freelancing work. So I might have to stop this at some point to do freelancing, which is also another thing that I want to do, which is go into these freelancing sites and then solve some of them for free until I gain a reputation and then start charging for freelancing work. But yeah, so ideally I would be able to make money out of this, but I think it's very unlikely because it's extremely competitive and everyone knows about these opportunities. So, and I'm also doing this on stream, which is definitely gonna decrease my chances a lot, but I think more on the long-term perspective, then it does make a lot of sense because essentially you don't lose anything by gathering data, and data is gonna be the most important thing. It already is, to some extent, but it's only gonna get more important. And then the more data you get, the better analysis you can do, and the better decisions you can make by the clarity you gain from those analysis. So I think it's a win-win situation where even though I'm risking my time doing this and might not make money, on the other side, I gain a lot of experience and I also gain the data. So there are less winners than losers in trading. So if you aren't willing to lose the money, that would be a good idea to invest. I played poker. I went from $15 to $4,000 in poker, and then I stopped doing that. So because I wanted to focus on programming, because I thought the opportunity cost of playing poker is too high, because it's not a translatable skill. But I know how the game works, and this thing about they're mostly losers than winners, this happens in everything in life. And it's both something in nature and also market economies mimic that behavior. And then governments are supposed to regulate the movement towards the Pareto distribution, but that doesn't happen because they are based on the incentives of the market economy, so they get corrupted over time, which makes things become more and more polarized, and that's why it is a problem in relationship to exponential tech, because it's out of synchronicity. The balance of the movement of the frequency from normal probabilistic distributions into Pareto distributions is not balanced enough in order to sustain the growth of exponential tech. And that's the reason why we need another system, or we're gonna self-destruct. My background is I did mechanical engineering and then I dropped out to play poker. That's about it. So I don't have much, but yeah. But I study all the time and think about these things all the time. And that's why I'm doing this stuff. Thank you. Yeah, who knows what's gonna happen, but hopefully I do believe that although it seems that everything points to disaster, as everyone says and thinks, because there's so many things that can go wrong and very little things that can go right, I do think that it's possible to find a solution, because there wouldn't be a problem if there was no solution. So the natural tendency of things is going to be to polarize. So either becomes really centralized with the data being used in a vicious cycle of control, where the people that have access to the data centralize everything, or it's going to be super decentralized, where we just kill ourselves because everyone can build an extremely powerful virus that can kill everyone. And just based on the probabilities, then it doesn't work. And the other side, it also doesn't work, because eventually the small circle of people that have power, because they are deluded, because you can't exist without a context, then eventually the deviation from the balance makes the power self-destruct. So because it is a distribution, there's always going to be an answer that is the balance between them. It's just a matter of finding the answer. So yeah, that's what I think everyone should be trying to do, because probably everything is going to be automated anyway, so because of technology. So it doesn't make sense to spend a bunch of time thinking about other things. I think I'm gonna go back to the place that I was there before I read this stuff. But it's good to know that there's gonna be further explanation here. I think I stopped here. Yeah. So this can easily be proven, though you mostly exercise. This fact implies that in the case where the reference market is infinitely liquid, as in 2.1, an arbitrage agent who considers a strategy several steps into the future cannot do better than simply solving 2 and executing the corresponding trade. So it's infinitely liquid, which means that the delta can go through infinity. Or you can reach the limit of the reserve, obviously. But the reserve is infinite, so yeah. Okay, that's fine. Thank you for the help, and have a wonderful day too. An arbitrage agent will consider strategy several steps into the future cannot do better. Okay. No depletion property. It turns out to be impossible to fully deplete Uniswap of all coins only by trading alpha and beta, even if the attacker has an unbounded amount of coins. We can easily show that the total reserve is always bounded from below. This follows immediately from applying the arithmetic geometric mean inequality. So I'm not sure why they assume that. Since this is true and K is non-decreasing and usually strictly increasing after each trade, so K is non-decreasing and usually strictly increasing after each trade. Then the total number of coins, the K changes because the price of the, but the price is based on the reserve, so. So why does the reserve the K gets bigger? I guess it's because the formula up there, which is this one. Because in this specific case, not in all cases, it's going to increase because you're balancing it out. To fully deplete. But I'm not sure if that's accurate, or because this seems to be relating to all the possible things. So it pretty much multiplied, took the square roots in both sides and multiplied it by 2. And saying that the sum of the reserves is going to be bigger than that. Or equal to. Which doesn't make sense to me, to be honest. Because it's the same as saying that R times RB is going to be equal to the sum. And that doesn't make sense. Since this is true and K is non-decreasing and usually strictly increasing, after each trade, then the total number of coins in Uniswap can never decrease below twice the square root of the initial product by only trading between coins A and B. So the total amount can never decrease below the 2 times square root of the initial product if you only trade the 2 coins. Yeah, this one I'm gonna have to spend some time. But I think I'm gonna continue reading because I understand the point, but the mathematics here, how they arrived at this solution, it doesn't seem like very logical to me. But I'm probably missing something. Increasing liquidity with increasing reserves, and intuitively the larger the amount of reserves, the less any one trade will cost. The marginal cost change of Uniswap, the negative of the infinitesimal price change of the Uniswap market after an infinitesimal trade can be computed by differentiated twice and is given by. So what this is saying makes sense, that the more money you have on the pool, the less each particular trade is gonna have an effect on the difference of the reserves. Yeah, the thing is, I don't understand really well the K thing. That's still, it has been and still is the biggest point of confusion that I have, which is understanding how the relationship between them is decided. Because obviously each token is going to have a different K because the prices are different. But I guess they reach an equilibrium through arbitrage. That's the thing that I'm not understanding. Yeah, so what happens is probably that, well, first people are gonna deposit already assuming the market prices, but if they don't, then, and that's why it's a risk. So you have to calculate before if you are a liquidity provider. Otherwise, we're just gonna put off-balance ratios, especially if you're in a small pool, putting a large amount of money, and then people are gonna arbitrage and you're gonna lose a lot of your money. So that's how it works, I think. And that's the thing that I'm missing, I guess, is that K always reaches the actual ratio based on the market dynamics of the outside world through arbitrage. So the larger the amount, the less each trade will cost, because it changes less the reserve. The delta in relationship to the reserve is smaller. And the negative of the infinitesimal price change of the Uniswap market infinitesimal trade can be computed by differentiating it twice and is given by. So it's differentiated twice between the deltas, or the equation above, I think, in relationship to the deltas. So what happens when deltas get to zero, basically? And it's going to be 2 times market Uniswap divided by the fee and times the reserve, where MU market Uniswap is the Uniswap price without fees. Note that 6 is strictly decreasing as RB increases. Strictly decreasing as RB increases. Assuming MU, the Uniswap price, stays constant. So isn't RA that makes the thing decrease? We can similarly show this property directly by assuming that we have 2 markets, one with strictly larger reserves and both with price. So assuming we have 2 markets, one with strictly larger reserves. So this one is the one that has larger, okay, both with price. So both have the same price, so the same ratio. In this case, assuming we trade delta alpha coins with both markets, we can show that the market will have a price gap of, okay, so the bigger one, the delta for the bigger one minus the delta for the smaller is equal to the market in Uniswap times the divided by the fee times delta. And they probably did some calculations here to get to this formula, obviously. So there's probably a lot of mathematical manipulation in order to achieve this. They pretty much, I think, they put one equal the other from the formula above and then got to this, I think. So it's delta alpha to the power of 2 times the difference between the reserves. Since this reserve is bigger, it's going to be a smaller number. And this is going to be between that. So between 0 and 1. Plus O. And then this other thing. And the delta divided by the reserve to the power of 2. This price gap is always positive in the case that R alpha, and this construction gives essentially a more precise version of 6. Yeah, obviously it's gonna be positive. It's gonna be higher if this is, yeah, because if this is smaller, then it's a negative number here. Derivation can be found in Appendix B. Cost of manipulation. In the no-fee case with an infinitely liquid reference market, the cost of manipulating the price of a constant product market can be bounded from below. If the attacker wishes to manipulate the constant product market, it should be 1 plus epsilon times market price. Okay, let me read this again. So if the attacker wishes to manipulate the constant product market, it should be this value. So they're trying to make the value be greater than the market price by epsilon amount, where MP is the true market price and epsilon bigger than 0 is some desired constant. Then the attacker requires an amount of at least, so this I assume is a mathematical proof that they don't show here. But the constant has to be greater than K times reserve B and minimum of these values. Coin beta for each period here. Coin beta for each period here. A period could be the time taken for a block to be minted, with K bigger than 0 or universal constant. So K is just a constant. This result implies that the cost of manipulating scales linearly with the reserve amounts. So there's a linear relationship between the size of the reserve and the manipulation, marking the importance of having large reserve pools. Additionally, the result extends immediately as a lower bound to the case with fees, for a derivation of 8 and an explicit bound of 1k. Liquidity provider returns. In the no-fee case, when gamma equals 1, I think I get it now. So the fee, which is 0.3%, I think, or something like that, will be the inverse of gamma here, in the sense that the less from 0 is equal to the, so if the fee is 0.3, then gamma is 0.7, I think. 0.3%, then gamma is equal to 0.97, I think. So it goes like that. We can easily compute the portfolio value of the Uniswap contract and correspondingly any liquidity provider. Let A, RA, RB, and MP to the, I'm not sure how to say this, but they are on the real thing, I guess. With the reserves for coin A, coin B, and the market price of a coin alpha, respectively, at each time t equals 1 through t. In the no-fee case, the no arbitrage bounds imply that market price equals the ratio, while the definition of a constant product implies that equals k for all t. So MP is equal to k. No, is equal to the, because one is multiplying, the other one is dividing, but combining both statements, is equal to this. RB equals square root of k times market price. We can use this expression to write a simple form for the relative return for Uniswap between time t minus 1 to t given by this complex equation here. To write a simple form for the relative return for Uniswap between time t minus 1 to t Okay. So we have MP times R plus RB divided by the previous time. Yeah, from t minus 1 to this. Equals, then you simplify here. And this is equal to the square root of this, of the difference in the market price. So it's dividing the final by the previous, and that's equal to the difference on the square root of the price. So that's the relationship here. The difference in the ratio of the reserve is equal to the square root of the ratio of the market price. This implies that the total relative gain for our Uniswap contract is the total portfolio value is this. So I think this is the symbol for summing, if I'm not mistaken, between the T1 and T2. Or T2. Because here is gonna be 1 and then T. And from T equals 2 until T. This is gonna be this relationship here. The portfolio value is gonna be this. So market price times reserve A plus reserve B times this omega, which is equal to this. Yeah, this they replaced here. I'm not sure if I really understand it, but I don't think it's worth it. Maybe it is, but I'm not gonna try to deduct the implicit things that are not here. Forgot what the name of that is. Derivation or demonstration of the formulas. Since this omega t depends only on the relative ratios of RA and RB, the result holds even when liquidity providers add tokens or remove tokens from the reserves. So even when the reserves fluctuate, the result holds true. Although in practice, as suggested by 6, the price is likely to be less stable in the case of smaller reserves. See Appendix C for further discussion. Because the arbitrage problem 2 and its risky variant problem 4 are convex, we suspect that the no arbitrage assumption is very likely to be met in practice. The convexity of this problem additionally implies that arbitrage can be efficiently performed even across several Uniswap markets. And the thing that makes this far more complicated as well is what happens when the other markets have a different equation for figuring out the price, because then you can't make the relationship based on the delta only. I guess you can have each equation the same principles, but for you just change the way that the delta is going to change the price based on the relationship that the equation gives. So I guess it doesn't change the relationship between delta A and delta B because they're always in the same exchange. It just changes the relationship between each one, each specific swap, which is going to be a different formula based on the price ratio. But it does change though, because at some point you're gonna have to make the bridge. So I think Yeah, because it's gonna be like a chain from delta A and delta B are connected in the same one, and then delta B to delta C is gonna be the bridge between the formulas. And that's the problem. Because then how do you calculate that? Yeah, I guess the issue that because then it's more complicated because as far as I understand for swapping in decentralized exchanges, there are some exchanges that allow cross chain trades, which means that you're trading from one protocol to another one, and then most just allow for the same protocol. So I think that in order to understand that, I have to understand more how does it work on the evaluation of price between the two, which is different because I've seen some videos and I think what they actually do is hold the abstraction of the coin instead of the coin itself, and then it's just assumed that you got the coin, but in reality what you got is a token that is equivalent for the other one. I think that's how it works. But then it's gonna be different for those because they're probably gonna have formulas or some ratio as well that says how they're gonna value the token from one exchange to the other. Or maybe you have, yeah, the issue is that if you have to pass the money through your wallet in order to go through the other one, you're obviously gonna pay more fees as well. But it is much more simple way because then you just do a swap and then you pass to your wallet. Then you do this other swap, taking the other formula into consideration. And then you just calculate the fees twice, which is obviously worse, but that's something to think about for the future. But first I have to understand this one better. Shown in 3, I think I stopped here. Because arbitrage problem 2 and its risky variant problem 4 are convex, we suspect that no arbitrage assumption is very likely to be met in practice. The convexity of this problem additionally implies that arbitrage can be efficiently performed even across several Uniswap markets. See Appendix A for more. As shown in, yeah, but then they assume that they're all gonna have the same formula for pricing their reserves. As shown in 3, we are analytically observe the effect that the Uniswap market fee has on the price of the market. The bounds guaranteed by the no arbitrage assumption become looser. In other words, as the fee increases or equivalently omega decreases, we expect as the fee increases or equivalently, yeah, so it is the relationship I was thinking about. The fee is equal to the inverse of. We expect the Uniswap market should deviate further from the price of a given reference market. We expect the Uniswap market should deviate further from the price of a given reference market. But doesn't that depend on the other market's fees as well? This is an interesting concept, actually. Because different markets always have different fees, you're always going to have arbitrage because the price is going to deviate given enough time. Very interesting. And it doesn't make sense to try to create a regulation so that all of them have the same fee. This is a very interesting idea. And it makes sense. I think I'm understanding this correctly. I'm not really sure, but Result 8 implies that when the reserves are large, the cost of manipulation is generally expensive for all but the smallest of changes. Though, due to the quadratic scaling, when epsilon is small, we can expect small changes to the price to be relatively inexpensive. This implies that protocols which depend on Uniswap or other constant product markets as a price oracle should not be extremely sensitive to small price fluctuations. Otherwise, it may be possible for an attacker with moderate resources to exploit this for their own gain. These properties combined with results 5 and 7 suggest that constant product markets are likely to be robust in the practical setting where the number of tokens in reserve is large and the number of trades is also large. Constant mean markets. A constant mean market is a market which generalizes constant product markets. First introduced in 18 constant mean markets, satisfy the following equation in the absence of fees. Is a market which generalizes constant product markets, so it's the aggregation of the constant product markets. So all the dexes that have constant product markets. So is the sum of 1 to the n, where R, I are the reserves of coin I equals 1, W containing the real numbers, I think, are the weights associated with each coin. Also the weight of the coin. And K to R is a constant product. In this case, the weights all satisfy bigger than 0 with 1t times the weight equals 1. In other words, in the absence of fees, constant product markets ensure that the product of its reserves stays constant, while constant mean markets ensure that the weighted geometric mean of the reserves, Ri for I equals 1, and stays constant. Similar to constant product markets, trading delta J amount of coin J for some amount delta J of a distinct coin should always satisfy the equation, which is the equation from above, but now is elevated to the weight of each one. Weight, I think, is the proportion of reserves given the two markets. So if the two markets have the same reserves, then obviously it becomes the same as trading within the market. And if they have different reserves, which is the weight, then it's going to take into consideration here by making it elevated by the weight. I'm not sure why though, don't explain, but if this is it can't be an arbitrary thing, it has to be something that was derivated or something like that, but so the weight is at least 1, I think. The weights all satisfy weight bigger than 0 with 1 elevated by t equals 1 times W equals 1. What is t again? Yeah, it doesn't say here, but I assume it's time. In the absence of fees, counterparty markets, yeah, it's probably the time. So as time goes by, it doesn't matter because it's always 1. And if it's 0, then the weight equals 1. That doesn't matter. Okay, so Constant mean markets ensure that the weighted geometric mean of the reserves stays constant. The product of its reserves stays constant, while constant mean markets ensure that the weighted geometric mean of the reserves. So I think this here is the formula here, the geometric mean, which is summing all of them and taking into account the weight of each one. For I equals 1, it stays constant. Where 1 minus omega is the percentage fee associated with trading coin J. The corresponding reserves Rj and Rl are updated as in true as in the main constant K. The other thing is here is not a delta, but I assume maybe it's not supposed to be. And so it's a different formula actually. Oh, it's probably the fee from both. The difference, that's why it is a different letter, is because it's the difference in the reserve between markets, I think. And the delta is the difference only on the markets, not in the bridge. Note that constant product markets are a special case of a constant mean market where n equals true, and we have weight 1 equals weight true, which is 1 divided by true, and omega 1 equals omega true. So when both fees are equal and the weights are equal to half, with the constant product k of 1 replaced with its square root. Also, it's saying square roots here. But the thing that doesn't make sense to me is that it just said that the weight has to be bigger than 0 here, and then here is saying that it's a special case when it's 0.5. So I don't understand how that makes sense. But I think I get that when both weights are the same, then it's gonna cancel out the square root of k, and it's gonna become the old formula. And the reserve is probably gonna be the delta instead of this one. This symbol here is gonna be the delta for the reserve val. Optimal arbitrage problem. You can write the optimal arbitrage problem for a constant mean market in the following way. So maximize the sum of that equation up there from 1 to n, depending on how many markets, which is the difference in the m, the price of one market, minus the delta of the m of the other one, elevated by p. No, it's not elevated by p. It's just the market from j to p and the market from I to p. Subject to this. So this is the portion of the first portion, the reserve, minus the sum of these differences here. So I'm not really sure if this is actually the delta of the... It probably is, because you have to take into account the difference of all the other ones, and this is stays constant because it's the initial one. So all the other ones are constant as well, but there are more of them because depends on the amount of others. And this is just always fixed because it's the first one. where we'll assume that is constrained to be 0 for notational convenience. So maybe it exists on the first one, but it's 0. The variables in this optimization problem are the amount delta to Rn, whose entries state how much of each coin to purchase from the external market. Yeah, the variables in the problem are the amounts. So amounts are the deltas. These entries state how much of each coin to purchase from external market. So you're solving for delta. While ijth entry of this states how much of coin I to trade for coin j. Yeah, which is basically the delta as well. So you're calculating the entry, which is the delta for the first one, and the exit, which is the delta for the second one. Since the weighted geometric mean is a concave function that is increasing in all of its arguments, it turns out that the equality constraint in problem 12 can be relaxed to an inequality constraint to get an equivalent but convex optimal arbitrage problem. For more details, okay. The equality constraint in problem 12 can be relaxed to an inequality constraint to get an equivalent. So this one because can be relaxed to an inequality constraint. I don't know what this means necessarily. I guess it's saying that if you change this from an equality and you put inside of an interval, then you have a convex optimal arbitrage problem. Yeah, it makes sense, I think, because it's saying that this equation is a concave function, but when you put this concave function within an interval, which is what you're trying to do because you're trying to solve for delta, then you have a convex problem, which is gonna probably fluctuate according to a parabola, I think, which makes sense because the higher the thing you're trying to take, the lower is the incentive and vice versa. So it has a global minima probably, or global maximum, I should say. Extensions and properties. Surprisingly, almost all conditions and properties, except the no arbitrage condition of 3, that hold for constant product markets also hold for constant mean markets in similar form. Describe a few cases below. Extensions. All the same extensions given in section 2.2 hold for problem 12. More specifically, for any convex function, which is increasing in its first n to the power of 2. Of 12 is an equivalent but convex problem with the additional penalty term. So the penalty are the fees and the other stuff, which is exactly the same logic they used first, but they used for A and B, I think, before, and now they are changing this to the sum of deltas and the initial delta. Yeah, this is gonna be very hard to put in coding format. If I wanna do this for all of the constant product markets, I think you have to do a recursive solution probably and put some if statements so that if there are no more markets, then yeah, but then it's hard to do. I think what I'm gonna try to do is put the first one and then I think about it. I'm gonna spend a lot of time thinking about how to integrate other ones. And I also have to read the bridge between different DEXs, how it works. I think in Ethereum, you probably, if you're only trading between DEXs that have the same tokens, then it's probably possible to go directly from one to the other one. Yeah, it's probably possible. So I have to just see what happens with the fees in the bridge there. And then I can use this formula for markets that are similar, but then for the other ones it's going to be really tough because I'm probably not going to spend time or not going to be able to derive the formulas myself for the other equations because it's going to be really time consuming. So I might have to, I'm probably going to have to compromise and get or think about some close approximation or maybe make the logic in a different way. So I think that's what I'm gonna do, and then once I achieve that, then I can think about if it's possible to optimize and how I'm gonna go about doing that. The same variables, delta, and as problem 12. If gamma less than 1, it is not hard to prove that any locally optimal point will have delta equals 0. Properties. Additionally, some of the same properties given in 2.3 hold essentially in their exact form for constant mean markets. All instances will have a non-decreasing product constant and satisfy the corresponding non-depletion property. The notion of increasing liquidity with increasing reserves also holds and can be easily derived from 18. Yeah, makes sense. No arbitrage conditions. It is, in general, not clear that there exists a closed form solution for the no arbitrage conditions specified in 2.1. It is possible to give simple, necessary, but not sufficient conditions on each pair of coins found in a given constant product market via similar argument to the one in 2.1, but we expect the general conditions are more complicated. This question represents the results for constant mean markets as they carry over nearly immediately from those given in 2. Though we suspect the markets which satisfy the constant mean properties such as balancer, where the idea originated, may become more important in the near future. So we focus on the specific case of Uniswap and more generally constant product markets. As other protocols such as Silo heavily depend on the robustness of this particular market maker mechanism. Agent-based simulation of Uniswap markets. While the properties presented in true lead us to believe that the Uniswap market is likely well behaved under most scenarios, it is hard to make stronger claims about the robustness of the Uniswap market mechanism without making assumptions that are unlikely to be realistic. To verify that this experimentally, we created an agent-based simulation by using the Gauntlet DSL to specify how several types of agents interact with the current Uniswap contract on a simulated Ethereum blockchain. The simulation environment interacts with the Uniswap contract deployed on a simulated blockchain via Python bindings. The environment allows for configuration of the network's initial conditions, including distributions of agent behaviors and agent-specific parameters. The simulation is run for a predefined number of timestamps. For each simulated timestamp, environment state variables are updated based on the state of the on-chain contracts. We additionally evaluate policies for adding new agents to the environment. We evaluate the utility of an action for a given agent and execute agent actions that have positive utility by submitting the corresponding transaction to the blockchain. Very interesting. So they pretty much ran a simulation of Uniswap on Ethereum to make analysis on the inefficiencies. The tested contract was based on commit in the Uniswap GitHub repository. It's obviously gonna get more complex because, and the longer the time goes, it's probably gonna get more and more complex in order to mimic the real behavior of markets. So apparently it doesn't exist anymore here. I'll be right back. Simulation markets. In the current simulation, we have two possible markets for agents to trade with. One is given by the Uniswap contract, and the other one is given by a simple stochastic market model. Uniswap market. When interacting with the Uniswap contract, an agent has a few possible actions they can perform. The agent can either A. Trade coins A alpha for beta, vice versa, subject to the constant product market equation, or B. Add or remove liquidity. In the latter case, an agent is able to add, say, delta B amount of coin B to reserve RB, and is required to also add this formula of coin alpha to reserve R alpha, because to maintain the constant thing. That makes sense. So if you're adding delta beta to beta, you have to add the ratio to alpha as well, to the other reserve. You have to add the k times the delta to alpha, which is whatever the ratio of alpha is to beta. The agent is then awarded, where R uni is the total amount of outstanding uni coins given by the contract. The agent can also similarly remove liquidity by burning delta uni coins. The contract then gives the agent delta alpha equals this, and delta beta equals this. Okay, I think I get it. And burns the given delta unit coins. This market mechanism allows the agents who purchase these uni coins, often called liquidity providers, to earn a profit given by the exchange fee, assuming the market price stays constant. Additionally, it provides a mechanism for adding and removing true reserves, thus making the Uniswap market more liquid, as shown in section 2.3. For the remainder of this section, we will assume the price of a Uni token is exactly given by the market price of the equivalent amount of coins alpha and beta that would be received by burning the token. Okay, let me read that again. Assume the price of a Uni token is exactly given by the market price. I think this is a good time to stop actually, because I can feel that I'm already getting tired. So I'll read until this line, this 4.2, and I'll stop. For the remainder of this session, we will assume the price of a Uni token is exactly given by the market prices of the equivalent amount of coins alpha and beta that would be received by burning the token. The price of a Uni token is exactly given the market price coins alpha and beta that would be received by burning the token. Okay, so the token is equal to the amount of coins. That's what this is saying. Additionally, the Uniswap contract defines gamma, which is 3%, 0.3%, the fee. The reference market follows a simple parallel model where the price MP of some coin alpha is updated in the following way. Okay. Where k bigger than 0 and epsilon bigger than 0 are given in the problem data. While it is possible for an arbitrager to solve the arbitrage problem exactly as it is a special case of 4, we choose a simpler risk model for the arbitrager, as the true market price model is not known in practice. Okay, so I think I understand this. The market price is going to be equal to market price plus k times the deviation, which is similar to the thing in the beginning there. And k is the constant. We additionally update the market price every time step after all agents have completed their actions in the following way. Here x tends to n between 0 and 1 is drawn from a normal distribution, and this remaining to r represent the mean returns and volatility of the market when no trades are performed. Okay, so which pretty much means that represents the shifting reserves, adding and removing liquidity with no trades. So this represents that. Simulation agents. There are three broad classes of agents used in this simulation: arbitragers who attempt to profit from the deviations between Uniswap and the market, liquidity providers who hold portfolios of unicoins and currencies, often beta, and traders who trade coins with Uniswap markets subject to simple rules. We describe each type of agent in detail below. Arbitragers. Arbitragers seek to maximize their profit by trading between the Uniswap market and the reference market. Oh, I thought I was going to stop here, but I guess I'm already here, so. Arbitragers seek to maximize their profit by trading between the Uniswap market and a reference market. An arbitrage agent solves an instance of problem 4 with a simple quadratic cost of risk model. So it's a function PB divided by 2 times the delta. It performs the necessary trades. Here, both against 0 parameters which control the penalty incurred for our trade. Okay. Use this model instead of the riskiness case of problem 2, as live systems have noise during trades, such that opportunity found by exact minimization of the riskless problem 2 may not be exactly executed or may close during the time it takes to perform the trade. Additionally, we are able to model a wide variety of risk-taking behavior by arbitragers by, for example, increasing the parameters PB, PA, and PB to have an arbitrager who is less prone to perform risky, large trades, even with large arbitrage opportunities available. Yeah, so it's basically taking into account different types of traders. Increasing the parameters P and B to have an arbitrager who is less prone to perform risky large trades. Liquidity providers. There are two types of liquidity providers who we model in the simulation. The first are the initial liquidity providers who begin the simulation by providing some amount of coins, often beta to the reserve, and seek to gain profits by taking fee from Uniswap trades. We assume these liquidity providers will not withdraw their position until the end of the simulation. The second are rational liquidity providers. These agents perform Markovitz portfolio optimization on the three possible coins in the market: alpha, beta, and the corresponding uni coin minted from the Uniswap market. Each agent then solves the convex portfolio optimization problem. So now this is something completely different than the thing I saw in the beginning. Makes the appropriate trades to rebalance the portfolio. In this problem is the vector containing the portfolio positions of alpha, beta, and uni respectively. Problem data is the vector of exponentially weighted average returns for each of the three coins with respect to the reference market, with this exponentially weighted covariance of returns, and omega bigger than 0 is dependency incurred by the risk. Since 14 is not known to have a closed form solution, we set up and solve problem 14 using the CVXPY 21 modeling language and the SCOC solver 22 in our simulation. The rational liquidity providers simulate agents who seek to maximize profits by trading their positions in each coin and holding their respective coins to maximize their expected return on investment based on observed historical averages. So they're pretty much using the data to figure out what their profits are going to be based on the trading behavior. Which is obviously not the solution because they're using historical averages and you can't predict the behavior in the future. Traders, the final agent we model is a trader. In this case, the trader seeks to trade some amount delta alpha of coin for some second amount delta B or vice versa, as long as the price of trading delta alpha coins on Uniswap differs no more than a constant percentage off from the same trade in the reference market. In a way, traders embody their demand for liquidity or the fact that trades on Uniswap might happen due to exogenous influence. In our case, the trader will draw delta alpha or delta beta from some probability distribution and check if performing this trade in the Uniswap market is at most some percentage more expensive than performing it in the reference market. If not, which to be fair is not realistic because obviously not pretty much very few people will do this. People usually are just gonna trade on whatever one is easier for them, I think. At least most people. If not, if the agent is able to trade with Uniswap for a reasonable price, then the agent makes the trade is in the Uniswap contract, otherwise no trade is performed. Yeah, I'm gonna go faster on this part because I don't think it's that relevant to what I'm trying to do now. So, and I think I'm already past the solution for the arbitrage problem, which is the equation up there, which is the equation that I have to translate into code. Which, yeah, I'm probably gonna spend a lot more time doing that actually. And yeah, so I think I'm gonna read this until I get to acknowledgements. because there's not a lot left. The results of our simulation suggest that the theoretical results derived above holding practices under a wide variety of market conditions. Arbitrage bounds. Figures 1 and 2 show that even under the presence of outside noise, such as random noise or changes in reserves due to rational liquidity providers, the marginal Uniswap price stays within the predicted no arbitrage bounds. In particular, Figure 1 shows when the market has a small amount of noise and little drift, while Figure 2 shows this when there is large negative drift with moderate noise. Find that these bounds hold in our simulations, even under large amounts of market noise and large drift rates, so long as the trades performed are not large. Due to the discrete nature of the simulation, if a trader is the last agent to run at each time swap, the no arbitrage bounds could be broken, as an arbitrager may not have yet been able to perform arbitrage. While this is true and is due to the nature of the simulation, the final result still clearly tracks the market price, as shown in Figure 3. Initial liquidity provider returns. In the simulation, we also record the utility of the initial liquidity provider, defined as the difference between the value of the respective uni coin the agent holds, as defined in 4.1, and a portfolio composed of the coins alpha and beta traded in for a uni at the start of the simulation. As shown in Figure 4, we find that in almost all of our simulations, initial liquidity providers end up having negative utility, using this definition, over most varying conditions. More specifically, we note that initial liquidity providers only have positive expected value when the mean market return is close to zero, as they earn revenue from all transactions fees while not falling behind an equivalent portfolio of the given pairs of coins. This approximately follows the results given in line, except that liquidity providers earn fees in this case. Conclusion: those simple constant product markets and their generalizations have very nice theoretical properties, such as fairly strict no arbitrage bounds on the reference price, which appear to hold in practice. Our simulations confirm that this is the case under a wide range of different market parameters and conditions, implying that the use of constant product markets as price oracles is, at least in first glance, sound. Additionally, we suspect that there is an even larger class of automated market maker mechanisms which satisfy the above properties, and it would be interesting to further explore its mathematical properties. We leave this possible generalization for future work. So I think, next time I'm probably gonna read this stuff here, and then I'm gonna go back to the other one and translate the formula into code. And I'm gonna do this for a long time while I do the other exchanges off stream. So see ya.